Good morning. This is Tom Alexander. It is Sunday, March 12th. It is 9:52 a.m. in beautiful Charleston, South Carolina. This is the weekly video addendum to the written report that you should have received. If you did not receive it and you would like to receive it, it's free. Shoot me an email to tom@alexandertrading.com. I'll put you on the list and you'll get all my this report weekly. Another announcement that I am adding benefits to our membership, and that will include 2 webinars a week. We're going to do a webinar on Tuesday post-market close and Thursday post-market close. And I think this is coming at a perfect time because of all the activity, shall we say, that's occurring in the market now. So it's a wonderful time. What we're going to be doing there, we're going to be discussing auction market principles, the current market condition, whatever it is at that point in time, and how to trade it. We do have a live room. We do day trading, but there's a much bigger world out there in trading and different time frames to trade, and we're going to be highlighting those different time frames in these Tuesday and Thursday webinars, including option strategies, ETFs, futures, the whole gamut of trading instruments that we have. It's not wise to trade one instrument in one time frame and ignore all the other opportunities out there in different time frames and different instruments. So we will be doing that beginning this Tuesday if you'd like to join us. In the meantime, if you find value in this video, please like it. Please subscribe to the channel. It's very, very helpful. Helps me grow the channel. It's really the only way to grow the channel is to have engagement. If you make comments, that's appreciated. Or if you have questions, let me know, and I will respond to every comment, every question. Thank you very much. Okay, let's talk about the markets. All right. I have been saying, those of you that have been following me for a while, for the past several months, I've been saying that it's been very confusing because the markets have been so disparate in terms of their market structure. We've had divergences of varying degrees between and among the 4 primary trading indices, the Dow, the Russell, the NDX, and S&P, the SPX. And what you will find, and this has been true, I've been trading 38 years plus, and this is always true. When there's true directional conviction in the market, institutional support for conviction, and that's really the only party in the market that can create a directional move and sustain that move are the institutions. What you're going to find, because the indices are so highly correlated, now they may be, one will be performing or underperforming another on a relative basis. That's not what I'm talking about. But when there's a substantial move in the markets, all 4 of the indices will participate. Last week, we saw the most consistent participation that we've seen since the end of December this year. So, and what was that? It was down. So let's take a look. Let's just start with the S&P. And this was last Monday. This was Friday's close. Now, last Friday, at the end of last week, I thought, oh, wow, this is a lot of upside momentum. This thing should have legs. Why don't we start the video, why don't I share my screen so you can see what I'm talking about? Now, okay, so here's the S&P. And so last Monday, this market traded higher, stopped on a dime, reversed, and then was straight down all week. Now, I'm going to go through these levels, but the bottom line here is I have a bearish working assumption that the market is going to be flat to down unless and until last Thursday's high is taken out by all 4 indices. So that's my working assumption. Now, we are in, I think, some stage of a waterfall decline that we have not seen in quite some time. And if you want to know what my definition of a waterfall decline is, it's something like this over here. We had several waterfall declines that last year, and they will be interrupted. Like this was an overall move here that lasted 20%, but you had legs within this where this was down 9, and then you bounce 6 or 7, and then you're down 12, and you bounce 6 or 7, etc. So that's what I think we'll be doing here. We've already traded lower off of the February high, down 6%, 6.5%, and then back up 4%. Now we're having another leg to the downside. So, and this is typical. This is how auction markets develop. So if you understand auction market principles and how auction markets work, what is coming, you have a decent idea. So we were down pretty sharply last week. We were down at a rate of change that's not sustainable. I can take you back to 2020 and show you something similar. So what I would be looking for this week is we may have some more panic for a few days. We have this banking thing going on. There's a Fed meeting tomorrow, so everybody's in a dither over that. You know, there's always something, guys. There's always some exogenous event, some attribution reason for the markets to panic. They'll panic, and then they'll stop, and then they'll rally, and then they'll balance. It's the same story over and over and over. That's what's so wonderful about understanding how auction markets work. Okay. Now, so what do I think is going to happen next week? Well, there's really not much support for this market until you get down to the December, January lows. I'm going to show you the profile view in a minute. It's clear there. But this is a volume node in here, and it does include the December and the January lows because they coincided prior to this bungee jump higher. But below here, you're looking down here at testing last fall's lows. Now, do I think we're going to go there next week? I don't think we are, but we all know anything's possible. But no, I do not think we'll go straight to that level. If we just go down to below this level somewhere, you're talking about, you know, another 2%. We could do that on Monday. We could do that in Globex, as a matter of fact. So we'll see. So this is the S&P. Let's take a look at this SPX. Let's take a look at now. Let's take a look at the NDX, because the S&P and the SPX index are very highly correlated. Now the NDX has been holding up relatively well relative to the other four, but there is absolutely nothing below Friday's low of significance in terms of potential support from a market perspective where previous trade has occurred, important pivots. Why is that? Because this was so vertical to the upside. You have these little minor pivot lows, but again, that's minor. I will be queuing my NDX trades off of what the S&P, the SPX is doing, but there's nothing but, you know, the NDX is truly in an elevator shaft here. It's in the abyss. This is Thursday high. You have to close above that high to restore any bullish working assumption. Okay, looking at, let's look at the Dow. Now, the Dow was part of this conundrum that began back in November, where it spiked to a high and then the others were lagging. Then you had a deep retracement in the others, a shallow retracement in the Dow, then the others went to a high. The Dow did not. So this is what I was talking about when you didn't have that consistent institutional directional conviction that we have now. And so the Dow is in the abyss. There is nothing from an auction market perspective that could provide potential support until you get down here. Now, understand, I'm not suggesting the Dow has to go to here. It could stop anywhere. I'm just saying there's no obvious level from previous trade over here that you say, oh, this is a very highly likely area for this market to stop. I'm not saying that, but you know, another 4% down. If we were to trade into this area by midweek, I would be a little bit surprised if we don't balance and retrace somewhat. Notice we're also below the 200-day moving average. in all the indices now. That's something institutions watch. Trades are triggered off of those levels, etc. Now let's look at the Russell. The Russell was down almost 9% last week. That is really, if the S&P or the Dow had done that, you'd hear a lot more about it. That's effectively a short-term mini crash. Now, below this level, we have last year's lows. We have the January, not last year's lows. We have this year's lows and the December low. And then below there, you're looking at 1668, 1640. So interesting times coming up this week. Let's take a look now at, well, I want to show you the profile view. Here's the, each profile unit is 1 month's trade. Each letter is 1 day. So if I compress this, remove the splits, this is what the profile looks like right now. Now I split this out for a reason. And the reason is so you can see recent trade activity. You know, market profile is a tool. It's not a means to an end. It helps us identify market condition. It gives a perspective that you don't get from bar charts. It gives a perspective of what's going on the horizontal scale. It cannot be rote traded, was not intended to be rote traded. There's no magic in any graphing format. There's no magic in market profile. It is a tool that is best used to identify market condition. So that's my weekly market profile rant. You can see clearly on this chart, this market profile chart, that the next level below where we basically closed on Friday is down here, the January and December lows. You can also see clearly where we have an initiative trade, conviction trading down. Now, there are a lot of possibilities from a market profile perspective what this could be. This could be forming the proverbial double distribution for you market profile semantic aficionados, where we trade lower in here and then we form a volume node here, and then you have single prints, and I won't get into the weeds there because it's not important. We'll be covering that as the market goes along anyway. But the point of this was to show you that from a profile perspective, your next level is down here, this year's lows, the January lows, and then the December lows. Okay, now let's take a look at the technical perspective of the market. And what we have here, I use NYSE data because it's data generated by the market. NYSE advancing minus declining issues. Also look at volume, but NYSE up versus down volume, or VOLD, VOLD, who may know what I'm talking about. It basically mirrors the advanced decline line. So, okay, the red moving average here is a 10-day moving average, 10-period moving average, in this case, days of NYSE advancing issues. The green is a 5-day moving average of NYSE advancing issues. It's sort of a slow-moving sentiment indicator. What you see here, the blue histogram, is breadth. It's closing NYSE advancing minus declining issues. We had 2 consecutive negative 2,000 closes. That is typical of a washout type of decline. It's relatively rare. It's extremely rare to have 3, and I don't recall even in 2020 if we had 4 consecutive negative 2,000 breadth closes. Now, what this is telling me, of course, it's going to depend on your time frame that you trade, which is why we're doing these Tuesday and Thursday webinars now. But strategically, you've got to be favoring the short side of this market in all time frames except intraday. Now, intraday is its own animal, as we all know. And the more compressed we get day after day, the more likely the intraday trade is going to be very volatile with wide swings up and down. So depending on the time frame you trade and the instrument you trade, there are different applications and there are different ways to trade it. Now, what I would be looking for if we do get just absolutely smashed on Monday, maybe into Tuesday, then I'll be looking for some sort of retracement, some sort of bounce. And of course, we will be revisiting that in these twice weekly webinars. If you would like to Avail yourself of that. Sign up for a membership. It's $97 a month. Cancel anytime, no partial refunds. Okay, let's take a look at VIX. And here's VIX. VIX spiked to its highest level in a long time. You can see the last time VIX was, we went out at about 24.80. And the last time we were that high was back here. And then ironically, we traded lower and VIX dropped. But, and I've been talking about this all year, we have seen good lows, at least for the last year. Now, high VIX is a relative term. A 30 VIX has been high for the past year, but I can go back and show you 40, 50, 60, 70 VIX too. So you have to, you can't just rote trade VIX. Again, it's part of understanding the bigger picture, understanding relative levels of things, whether it's breadth or VIX or any of these other things. But if we're going to see lower prices and we see some more panic next week, I would be really surprised if we don't see VIX around 30. Now, this brings me to another opportunity to tell you a little bit about what we're going to be doing on Tuesday, Wednesday evening. High VIX is a wonderful environment for certain types of option trades. So we're going to be exploring those things as well in these webinars. But the exciting thing about trading, guys, is that there's so many different instruments, there's so many different market conditions. And when you can combine the proper instrument with the proper market condition, first of all, it's fun, but it's also much, much more profitable. And it is not as mind-numbing as staring at a screen all day long, trying to trade 75 times in and out of the S&P Mini. So, guys, I hope you enjoyed this. Again, if you did enjoy it, please like it, please subscribe. I will answer all questions and comments. Have a wonderful week.